Credit to bank insiders, Reg O, from page 66 of the Reference Guide to Regulatory Compliance. Although Federal Reserve Act restrictions on lending to insiders by reserve member banks date from the 1930s, it was changes to these restrictions in the FIRA, Financial Institutions Regulatory and Interest Rate Control Act, enacted in 1978, which formed the basis for Reg O, loans to executive officers, directors, and principal shareholders of member banks today. Part of the purpose of that act was to control the lending activities of financial institutions to executive officers, directors, and principal shareholders of the institution. These changes were enacted because in the 1970s, some well-publicized cases of banks providing special beneficial lending arrangements to executive officers and directors occurred, as well as some high-profile bank failures traced to insider lending. These practices were considered to be abusive. The Federal Reserve Board greatly amended Reg O to implement the insider transaction provisions of FIRA. Additional insider lending abuses in the 1980s led Congress in 1991 through the Federal Deposit Insurance Corporation Improvement Act (FDICA) to make additional changes to the insider lending laws, and Reg O was amended accordingly. In 1994-97, the Federal Reserve Board further amended Reg O to liberalize the record-keeping requirements and the insider lending rules. In 2006, the Fed issued an interim rule amending the requirements of Reg O to eliminate several required disclosures, including the aggregate amount of insider loans reported on the call report and loans by executive officers to correspondent banks. These were not found to be useful in preventing insider lending abuse. Reg O governs two major areas: lending to insiders and disclosures of loans made to insiders. Reg O both restricts lending to insiders and requires that certain loans to insiders be disclosed. Each banking agency has adopted the provisions of Regulation O for administrative enforcement purposes. In 2011, as a result of the transfer of authority from the OTS, which was eliminated by the Dodd-Frank Act, to the Federal Reserve Board, Reg O was amended to cover savings associations. Coverage is executive officers, being those who participate or have the authority to participate in major policy-making functions. This definition includes any person, even if the person is serving without a title or without compensation, or if the person denotes the person as an assistant. Unless excluded by a board resolution or the bylaws, the following officers will be considered to be executive officers. That's chairman of the board, the president, each vice president and above. For example, senior vice president, executive vice president, and so on. Cashier, secretary, and treasurer. Even if excluded by board resolution, these officers will be considered to be executive officers if they participate in major policy-making functions. An extension of credit to an executive officer of an affiliate of the bank, except a company that controls the bank, will be subject to the specific lending restrictions and record-keeping requirements of the officers specifically excluded from major policy-making functions of the bank by either a board resolution or the bylaws of the bank, and the affiliate's assets do not constitute more than 10% of the assets of the company that controls the bank, nor is the controlling company owned by any other company, and the executive officer of the affiliate is not otherwise subject to restriction. Directors are covered under Reg O. Directors of the bank, regardless of whether they receive compensation, any director of an affiliate of the bank, unless the director is specifically excluded by board resolution or the bylaws of the bank from major policy-making functions. The subsidiary does not control the bank, and the affiliate's assets do not constitute more than 10% of the company that controls the bank, nor is that company controlled by another company. An advisory director is not considered to be a director if he or she is not elected by the shareholders, is not authorized to vote in board meetings, and provides only general policy advice to the board. A principal shareholder, an individual or company other than the insured or foreign bank that directly or indirectly owns, controls, or has the power to vote more than 10% of any class of voting securities of a bank, or a principal shareholder owning stock owned by family members, shares of securities that is owned and controlled by an individual's immediate family are considered to be held by that individual. Immediate family means an individual's spouse, minor children, and any children living with the individual's home, including adults, can cause a person to be covered under Reg O as a principal shareholder because they own by themselves and through their immediate family a controlling interest in the bank. Related interests are covered under Reg O. That's a company controlled by a person, or a political or campaign committee controlled by a person, or from which a person receives funds or benefits. Affiliates. An affiliate is a company of which the bank is a subsidiary or any other subsidiary of the same company of which the bank is a subsidiary. And control is a person who has control of the bank or company if he or she owns, controls, or has power to vote directly or indirectly 25% or more of any class of voting securities of the company, and is a director or executive officer who owns, controls, or has power to vote 10% or more of any class of voting securities. Furthermore, control requiring consideration under Reg O is those who own, control, or have the power to vote more than 10% of any class of voting securities of the company, and no other person owns, controls, or has the power to vote a greater percentage of that class of voting securities. And lastly, in any manner, controls the election of the majority of directors or the company or bank. Extension of credit covered under Reg O is that the credit covered under Reg O is any new loan or renewed loan or line of credit, purchasing securities, other assets, or obligations in a repurchase agreement, advanced by means of an overdraft or cash item, issue a standby letter of credit or an illegible acceptance, acquire any note, draft, bill of exchange, or other debt on which an insider may be liable as a maker, drawer, guarantor, endorser, or surety, and increase existing indebtedness except that a bank's advance of funds for its own protection for interest, taxes, insurance, and so forth is not considered to be an extension of credit, and an advance against unearned salary for a period in less than 30 days, which is like payday lending. The following are not extensions of credit. These are advances against accrued salary or other accrued compensation, advances for the payment of authorized travel incurred on behalf of the bank, the receipt by the bank of a check for deposit in the normal course of business, and acquisition of notes, drafts, bills of exchange, or other debts through a merger or consolidation of banks or other transactions whereby a bank assumes or acquires the assets of another institution. Debts of $15,000 or less if represented by charge accounts, time accounts, or credit cards, and debts of $5,000 or less arising under an interest-bearing overdraft protection plan. An endorsement or guarantee for the protection of a bank or any loan or other asset previously acquired by the bank in good faith. Tangible economic benefit rule is an extension of credit will be deemed to be made to an insider if the proceeds are transferred to the insider or used for the insider's benefit. This rule does not apply if the credit is made on substantially the same terms and conditions as those made to a non-insider, and if the proceeds are used for a bona fide transaction involving the acquisition of property, goods, or services from the insider. Requirements under Reg CC is certain lending restrictions. Banks may not lend to executive officers, directors, principal shareholders, or any other related interests unless the credit is made on substantially the same terms and following credit underwriting standards that are not less stringent than those on loans to persons who are not insiders. However, the bank has a benefit program widely available to employees. It may lend to insiders on the same terms and conditions as it lends to other employees pursuant to its employee benefit program. Loans to insiders are
What time you want me to make supper?
Oh, any time, Nan.
Hey, don't lean back on her. You're going to upset, babe.
Loans, thanks, Nanny. Loans to insiders must pose no greater credit risk to the bank than loans to outsiders. Banks may not lend to any executive officer, director, or principal shareholder, and to any of their related interest amounts that exceed the higher of $25,000 or 5% of the bank's capital and unimpaired surplus, up to the maximum of $500,000 in the aggregate, unless the credit is approved in advance by the board of directors and the interested party has abstained from voting. Prior approval is not needed for each withdrawal against a line of credit, provided the line of credit was approved within the preceding 14 months based on the then current financial statement. No insider may knowingly receive or allow his or her related interest to receive a loan from the bank that is not in compliance with Reg O. The maximum aggregate amount of credit that the bank may exceed to a single insider, including his or her related interests, is equal to the bank's legal lending limit, which is 15% of the unimpaired capital and surplus. A bank's limit may increase an additional 10% of capital and unimpaired surplus for loans fully secured by certain readily marketable collateral, such as a perfected security interest and obligations to the United States on an unconditional take-out commitment by any department or agency of the United States, a perfected security interest in its segregated deposit in the bank, and a full or partial recourse guarantee by the insider of purchase installment loans where the bank documents the insider's financial condition in its records. The bank officer designated by the board of directors certifies in writing that the bank is relying primarily on the consumer for repayment, and the obligated consumer is not an insider of the bank or one of its affiliates. The maximum amount of credit that the bank may extend to all of its insiders is known as the aggregate lending limit, which is equal to 100% of its unimpaired capital and surplus. Any bank with assets of less than $100 million may, by an annual resolution of the board of directors, increase its aggregate lending limit to 200% of its unimpaired capital and surplus, providing that the bank meets or exceeds all regulatory capital requirements, and the bank received a composite rating of at least satisfactory during its most recent examination. The board of directors annually resolves that such an increase is consistent with prudent, safe, and sound banking and is necessary to retain or attract directors and to prevent restricting credit in small communities. The resolution sets forth the facts and reasoning on which the board bases its finding, including the amount of credit outstanding to insiders on the date of the resolution as a percentage of impaired capital and surplus. Overdrafts. No bank may pay an overdraft of an executive officer or director unless the payment is made under a written pre-authorized credit plan that specifies the method of repayment or pursuant to a written agreement to transfer funds from another account. Overdrafts may pay inadvertent overdrafts of $1,000 or less in the aggregate if an account is not overdrawn for more than 5 business days and the executive officer or director is charged the same fee charged to other customers made under the same circumstances. The overdraft restrictions do not apply to payment of an overdraft of a principal shareholder unless the shareholder is also a director or executive officer. They also do not apply to related interests. Limits on loans to executive officers. The bank may lend to executive officers as follows: any amount to finance the education of the officer's children, or any amount to finance or refinance the purchase, construction, maintenance, or improvement of the officer's residence if secured by a first lien on a residence. In any amount if the loan is secured by U.S. government obligations and U.S. government agency or segregated deposits in the bank, and for any other purpose amounts up to a higher of 2.5% of the bank's capital unimpaired surplus, or $25,000, but not to exceed $100,000. Must require a detailed current financial statement from an executive officer before making a loan to that officer, and must place a provision in the loan document that the loan is payable on demand if the executive officer becomes indebted to any other bank or banks in the aggregate amount greater than the amount the officer could borrow from his or her own bank under Reg O. These restrictions also apply to loans to partnerships where one or more executive officers or partners who, either separate or together, hold at least a majority interest in the partnership. Disclosures to be made to the board of directors. Public disclosures are explained here. Executive officers must promptly report to the board of directors any extension of credit received from the bank. Executive officers and directors of a member bank, the shares of which are not publicly traded, must report annually to the board of directors the amount of outstanding loans secured by the stock of the bank. Public disclosure required on written request from any member of the public. A bank must disclose the names of each of its executive officers and principal shareholders to whom the bank has aggregate credit outstanding at the end of the latest quarter that equaled or exceeded 5% of the bank's capital and unimpaired surplus, or $500,000, whichever is less. No disclosure is required if the aggregate credit was $25,000 or less. Disclosure of individual loan amounts is not required, and records of compliance with the public disclosure rule must be maintained for 2 years, including identification of all executive officers, directors, and shareholders and their related interests. The record-keeping requirements showing compliance with Reg O must be effective, say, as long as the credit is extended. And that's actually 3 years of debts to correspondent banks. And enforcement of FIRA is what you'd regularly expect. There's civil penalty $5,000 a day to persons and the bank.